Welcome to the Deep Dive. We take stacks of research articles, all those notes, and we boil it down for you. We find those key insights, save you time, and still hopefully give you those aha moments. Today we are diving deep into JinkoSolar. Ticker's JKS. You've probably heard of them. They're one of the absolute biggest names in solar globally.
Huge. A real titan.
Exactly. And the core question we're tackling, really the heart of the investment case here, is this. Can the world's largest solar panel maker, this giant of tech and scale, actually navigate what looks like a perfect storm? We're talking brutal industry price wars on one side and really punishing geopolitical tariffs on the other.
It's a tough spot.
So is it a giant about to get crippled?
Yeah.
Or can it weather this? It's this clash, isn't it, between that long-term secular growth story, renewables of the future, right, and the really harsh short-term reality of an industry that's kind of becoming a commodity.
That's precisely the tension. And just for context, our analysis today is based on data from June 13th, 2025. JinkoSolar's ADS, the American shares, closed at $19.48 that day.
Got it.
So we'll break down their business, take a look at the management, dig into the financials, and importantly, lay out the big risks they're facing.
Okay. And before we really jump in, just a quick reminder, if you like what we do here, please hit like and subscribe on the Stock Analytics AI YouTube channel. It really helps us out.
Definitely.
And hey, if you're a member, it's just $4.99 a month. You get priority deep dives. You suggest a ticker, it moves up the list.
Yep.
By the end of this, you should have a much clearer picture. Is Jinko a hidden opportunity maybe, or is it just a classic value trap? All right, let's get into it.
The foundation, business, management, and financials.
Okay, first up, Chapter 1. Business understanding. Let's get our heads around Jinko's core operations. How do they actually make money? What are they selling?
Right. So Jinko operates on what's called a vertically integrated model. Basically, they control almost the whole process.
From start to finish.
Pretty much. From making the silicon wafers, those are like the basic building blocks, all the way through to the finished solar panels or modules. Their main revenue driver is selling these high-efficiency solar products.
And what's the star product right now?
That would be their N-type Topicon Tiger Neo modules. That's TOPCON. These are really important. They made up something like 98% of their module shipments in Q1 2025.
Wow, 98%. So that tech is key.
Absolutely key. N-type Topicon is kind of the leading edge right now. It's more efficient than the older P-type cells, especially when it gets hot, so you get more power out of the same space. They're also branching out into energy storage solutions, ESS batteries, basically, under the EGL storage brand. And they do system integration, too.
Okay, that vertical integration sounds efficient. But you mentioned they're global. How global are we talking? Where do these panels end up?
Yeah, that's a really critical point. Jinko is incredibly reliant on the global market. Get this. 70%, 70 of their Q1 module shipments went outside China to overseas markets.
70%. So hugely dependent on international demand.
Massively. It shows their reach, definitely. But it also means they're exposed to, all sorts of geopolitical stuff and complex logistics.
They ship everywhere. Does that translate to being the biggest player? And what makes them stand out besides just the tech?
Oh, they are absolutely dominant. They were the first manufacturer ever to ship over 320 gigawatts cumulatively.
320 gigawatts. That sounds like a lot.
It's enormous. Think hundreds of thousands of homes per gigawatt. They're consistently ranked #1 globally for module shipments. But the real value proposition, and this is super interesting for you listening, is their bankability.
Bankability. What does that actually mean in practice?
It means financial institutions, banks, lenders, they trust Jinko panels enough to finance huge multi-million-dollar solar projects that use them. They're confident these things will actually perform for 25, maybe 30 years.
Okay, so it's about trust and long-term reliability.
Exactly. They got a 100% bankability rating from Bloomberg NEF in 2024, AAA from PV Tech. This reputation isn't just nice to have, it makes it easier for their customers to get the loans they need for these big projects. It's a powerful competitive edge that isn't just about price.
That sounds like a huge advantage. But, okay, let's zoom out to the industry. The long-term picture for solar seems great, right? Decarbonization, AI data centers needing power.
Yeah. The long-term drivers are definitely strong.
Yet all we hear about is this brutal price war. How do those two things coexist?
It's a total paradox, isn't it? You've got this fantastic long-term outlook, like you said, decarbonization goals, more electricity demand, projections for installations to grow another 10% in 2025 to 655 GW globally. That's massive.
Right.
But That bright future is completely overshadowed right now by this short-term crisis. There's just way too much manufacturing capacity globally, too many factories making too many panels.
Oversupply.
Massive oversupply. And that has triggered this vicious price war. Everyone's slashing prices just to move inventory, and it's absolutely crushing profitability for pretty much everyone in the industry.
Okay, so within that bloodbath, who are Jinko's main competitors? And how do things like tariffs, especially U.S. tariffs, hit a global player like Jinko?
Well, their main rivals are other big integrated Chinese manufacturers. But it's interesting. Even though Jinko is the volume leader, its market cap around $1 billion is way smaller than some U.S. peers, like First Solar, for instance.
That's a big gap. Why?
It really reflects the market's worry about geopolitical risk. And that brings us right to the biggest single challenge, those U.S. anti-circumvention tariffs that were finalized in April 2025.
Anti-circumvention, so trying to stop them dodging existing tariffs.
Exactly. By shipping through third countries, these tariffs hit Jinko hard, specifically a 41.56% rate on products from their Malaysian facilities.
Ouch. And Malaysia was set up for the U.S. market, wasn't it?
Yeah. Precisely. They built those factories to serve the U.S. market, trying to get around earlier tariffs. So this isn't just a general industry problem. It's a direct, targeted hit on Jinko's strategy. Very punishing.
So with all that pressure, price wars, targeted tariffs, what advantages does Jinko still have? It can't just be size, can it?
No, it's more than size, though. That's part of it. Their key strengths are still that #1 market share, the huge economies of scale that come with it, their tech leadership, particularly in N-type tall pecan. They've got like 462 patents there, and that critical bankability factor we talked about.
Right.
Historically, that scale gave them a big cost advantage. They could make panels cheaper. But that advantage is shrinking fast because of the price war, and those U.S. tariffs are forcing them to rethink everything, potentially shifting to higher-cost factories elsewhere. It's a tough pivot.
Okay, that sets the stage. Let's move to Chapter 2. Management evaluation. How's the leadership team under co-founder Xiande Li handling all this? What's their game plan?
Well, you have to give them credit. The management team, led by Xiande Li, has an impressive history. I mean, they scaled this company to be the world leader. That's not easy.
Sure.
Their response to this current mess is what they're calling global manufacturing 2.0. The idea is to build local factories in key markets. So they're planning a 1 gigawatt module plant in the U.S. and this huge 10 gigawatt integrated facility in Saudi Arabia.
Local for local, basically. Seems logical given the tariffs.
It is logical. It addresses the tariff issue head on and helps with local supply chains. And it's it's incredibly expensive. We're talking massive capital investment. And there's always risk when you're building and operating in new places.
A risky bet, especially now. You mentioned a narrative gap earlier. Can you expand on that? What's management saying versus what the numbers show?
Yeah, this is something that frankly raises a bit of a red flag for me. If you read Jinko's press releases, they're always positive. Awards, partnerships, great ESG ratings. They have a BBB from MSCI, which is decent. It paints a picture of success. But then you dive into the actual financial reports, the filings, and it's a completely different story. Collapsing margins, net losses. It's pretty grim.
So a disconnect.
A significant disconnect. And it makes you wonder, right? Is management just focused on the long game, trying to keep morale up while weathering the storm? Or are they maybe using these non-financial wins to distract from how bad the financials actually look right now? It's hard to tell.
And how does that translate into where they're putting their money, their capital allocation choices?
Well, they are definitely investing heavily in the core business. You see that with the plan to raise about $620 million. That's RMB 4.5 billion for that expansion, those new factories. That fits the strategy.
Okay, that makes sense.
But here's the really puzzling part, and it raises serious questions. On June 13th, 2025, they declared a cash dividend.
A dividend.
Wow.
They're losing money.
Exactly. 4.325 cents per ordinary share, which is $1.30 per ADS. They're doing this while reporting significant losses and burning through cash. So essentially, they're paying that dividend out of cash they already have, or maybe even borrowing more, not from profits.
That seems counterintuitive, to put it mildly, especially with massive expansion plans needing funding.
It does raise questions about judgment and priorities, absolutely.
So paying dividends while losing money, spending big on expansion, what does this do to shareholder value? Are they actually creating value with these investments?
This is where it gets pretty stark for investors. We look at something called return on invested capital, or ROIC. Think of it as the profit you generate for every dollar you invest in the business.
Okay.
Jinko's ROIC is negative. estimated somewhere between negative 1.5% and maybe negative 4.3%. So for every dollar they invest, they're actually losing value.
Losing money on their investments.
Yes. And then you compare that to what it cost them to get that money in the first place, their weighted average cost of capital, or WACC. That's estimated around 2.6%.
So it costs them 2.6% to get capital, but they're generating a negative return on it.
Precisely. They are actively destroying shareholder value with every dollar they invest right now, and that context makes the aggressive expansion and the dividend payout look particularly concerning for anyone holding the stock long term.
Wow. Okay, that leads us perfectly into Chapter 3, financial analysis. Let's really get into the numbers and see the damage. What are the key financial headlines?
All right, the market cap, as we said, is just over $1 billion. Now, revenue growth was explosive from 2020 to 2023, but then, bam, a sharp drop in 2024, down almost 23%.
And that's even while shipping more panels.
Exactly. Shipments grew, but revenue fell. That's price collapse hitting hard. Profit margins, they're alarming. Gross margin fell to about 11% in 2024, and in the last quarter of that year, Q4, it was just 3.6%.
3.6%, barely breaking even on the product itself.
Barely. Operating margins are negative. Net margins, gone. They reported a loss per share of $2.85 in the first quarter of 2025.
Oof. Okay, so profits are gone. How stable is the company overall? What about debt and cash?
Well, free cash flow is very volatile, often negative. That means they're relying on outside money debt or equity to fund operations. Earnings are super inconsistent, making it hard to predict anything.
And the debt?
It's substantial. The debt-to-equity ratio is 1.35. That translates to almost $5.9 billion in debt. That's a heavy load, especially in a downturn like this.
Any safety nets?
Liquidity.
Their current ratio looks okay on the surface at 1.33. That measures short-term assets versus liabilities, but the quick ratio, which excludes inventory.
Right, because inventory might be hard to sell quickly in this market.
Exactly. The quick ratio is only 0.85. That suggests if things got really tight and they couldn't shift those panels fast, they could face a real cash crunch. And, like we discussed, that dividend is just not supported by current earnings.
Given all that, how is the market pricing this? What do the valuation multiples look like? Anything positive there? Well, because they're losing money, the price to earnings, or PE ratio, is negative, so it's not useful. But look at price to sales, PS. It's incredibly low, 0.09.
0.09. So the market values the whole company at less than 10% of its annual sales.
Yes. And price to book, PB, is also very low, 0.41, meaning it's valued at less than half its theoretical liquidation value on paper. These are what you'd call deep value multiples.
Screamingly cheap on the surface.
On the surface, yes. It signals extreme pessimism from the market. Investors basically don't believe those sales will translate into profit anytime soon, but it also flashes that warning sign. Could this be a value trap? Cheap for a reason and likely to stay cheap or get cheaper.
Right. The classic trap. What about trying to estimate an intrinsic value? I know DCF models are tricky here, but what does an educational one suggest?
Okay, so running an educational discounted cash flow model, which tries to project future cash flows and discount them back, it suggests a potential intrinsic value range somewhere between, say, $22 and $30 per share.
Which is above the current price of around $19.50.
It is. But you have to understand the assumptions baked into that model. It assumes negative revenue growth for the next year or two, then a gradual recovery in both growth and margins later on.
So heavily dependent on that recovery happening.
Hugely dependent. And DCF models are notoriously sensitive to assumptions, especially for cyclical companies in turmoil like this. So that range is really just an illustration, definitely not a prediction or a guarantee.
Market, ownership, risk, and conclusion.
Okay, let's move into Chapter 4. Market sentiment. How are the pros, the analysts, and the broader market actually feeling about JinkoSolar right now? What are the vibes?
Well, the analyst community is, let's say, deeply divided. That itself tells you something. You've got price targets all over the map. Some analysts are super bearish, down at $11, while others are incredibly bullish, up at $65.
That's a massive range. What's the consensus?
The consensus, if you can call it that, leans heavily towards hold, reduce, or even strong sell. There's a real lack of conviction. Very few outright buy ratings.
Interesting. And you mentioned that narrative gap again, company PR versus financial news.
Yeah, it's stark. Jinko's own newsfeed is relentlessly positive awards, milestones, ESG achievements. But then you read independent financial reporting, and it's all about the tariff impact, the plunging profits, the price war. It's like two different companies. That's why digging into the actual data like we're doing is so critical for you.
Absolutely. Beyond analysts, what other market signals are flashing? Is there heavy betting against the stock?
Oh, yeah. The short interest is exceptionally high. Depending on the source, it's somewhere between 11.4% and 15.4% of the available shares, the float.
So a lot of people are betting the price will fall further.
A significant number, yes.
Mhm.
It's a clear bearish signal from the market. But high short interest also creates the potential for a short squeeze. If some unexpected good news hits, those short sellers might rush to buy back shares to cover their positions, which would temporarily spike the price.
Right, the squeeze potential. What about technically? How does the chart look?
Technically, it's a mixed bag, leaning negative. The stock is trading slightly above its 50-day moving average right now. That's around $17.70 to $18.04, suggesting maybe some short-term positive momentum.
Okay.
But importantly, it's still well below its 200-day moving average. It's up around $21.08 to $21.49. And that longer-term average usually signals the underlying trend, which in this case is still clearly down.
Got it. Let's turn to Chapter 5. Ownership structure. Who actually owns JinkoSolar shares? And crucially, what are the insiders doing?
Institutional ownership, think big funds like Vanguard, BlackRock, it's moderate, somewhere between 15% and 36% depending on how you measure it. They have positions, but if you look at their recent buying and selling, it's mixed. No strong, unified move either way.
So the big funds aren't making a strong bet either way. What about insiders, management founders?
Now that is really interesting. Insider ownership is highly concentrated. The founders and key management control a huge chunk, potentially up to almost 40%, 39.78% by some counts.
Wow, nearly 40%. So they have a lot of skin in the game. The stock's trading at these super low multiples. Surely they must be buying hand over fist if they believe in the turnaround.
You would absolutely think so, wouldn't you, if they genuinely believed it was a bargain basement price. But here's the kicker.
Okay.
In the last 12 months, there have been precisely 0 open market purchases by corporate insiders, and also 0 open market sales.
0 buys and 0 sales. Complete silence.
Complete silence. The other lack of insider buying, especially when the stock looks so cheap on paper and they own so much already, is what I'd call a profoundly bearish signal. It's deafening.
Why is that so significant?
Because who knows the company better than the people running it? If they aren't stepping up to buy shares at these levels, it suggests either they don't see the value the market might perceive, or maybe, just maybe, they're aware of challenges or risks that aren't fully out in the public domain yet. That silence speaks volumes.
Okay, that's a powerful point. Let's try and pull all these threads together in Chapter 6. Risk assessment. Using a SWOT framework. Strengths, weaknesses, opportunities, threats. What are Jinko's core strengths?
Their strengths are undeniable, even now. That #1 global market share, huge scale, their tech leadership with N-type T-Punkan, and that all-important bankability factor.
And the weaknesses. Mostly financial, I assume.
Predominantly, yes.
Yeah.
The negative and volatile profitability, the high debt level, that negative ROIC actively destroying value currently, and potential liquidity worries highlighted by the quick ratio.
Okay. What about opportunities? Is there any light at the end of this tunnel?
There are opportunities, definitely. The biggest is just the long-term growth trend for solar energy itself. That's not going away. They're also expanding into energy storage systems, ESS, which is a smart adjacent market.
Diversification.
Exactly. And here's a more strategic thought. In this brutal industry shakeout, if weaker competitors go under, Jinko, because of its sheer size and bankability, might actually pick up market share and emerge even stronger when things eventually turn around. It's a possibility.
A last man standing scenario. What about the threats? General industry and macro risks first?
General threats include the ongoing destructive price competition driven by that overcapacity, volatility in raw material costs, silicon, silver, etc., and always the risk that some new disruptive solar technology comes along and leapfrogs them.
And macroeconomic.
Persistently high interest rates are a killer. They make financing big solar projects more expensive, dampening demand. And inflation obviously increases their manufacturing costs.
Okay. Those are broad risks. But what's the single biggest, most acute threat facing Jinko specifically right now?
No question about it. It's geopolitical. It's those U.S. anti-circumvention tariffs finalized in April 2025.
The 41.56% hit on Malaysia.
Exactly. That tariff directly undermines their whole strategy of using lower-cost Southeast Asia to serve the high-margin U.S. market. It forces them into this really tough corner.
Either give up the U.S. or build expensive factories there.
Right. They seem to be choosing option 2, that global manufacturing 2.0, building in the U.S. and Saudi Arabia. But that requires enormous capital, leads to a much higher cost base, and carries significant execution risk. This isn't just a temporary blip, it's a potentially permanent hit to their ability to make money in a key market. It is the central pillar of the bear case.
Okay, that's crystal clear. So this brings us to Chapter 7, conclusion. Let's synthesize everything. Compelling arguments on both sides. Lay out the bull case first. What's the argument for JinkoSolar?
The bull case is definitely a high-risk, deep-value play. It's all about survival and eventual dominance. The argument is you're getting the world's undisputed #1 solar module shipper, a tech leader in N-type, at what looks like fire sale prices. Price to sales below 0.1, price to book below 0.5. That's incredibly cheap.
So the bet is they can survive the storm.
The bet is that their scale, their tech, and their bankable brand will allow them to outlast weaker rivals. And if or when the industry consolidates and prices recover, Jinko, as a survivor, could see its stock price absolutely rocket. It's a bet on a massive recovery.
Okay, that's the bull case. High risk, high potential reward. Now, the bear case. Why might it be a value trap?
The bear case argues Jinko is a classic value trap. It says this is fundamentally a structurally unprofitable commodity business right now, their old low-cost advantage.
Neutralized by oversupply and those targeted tariffs.
And the financials back that up.
Absolutely. The financials are precarious. They're destroying shareholder value, negative ROIC below WACC. They have tons of debt. They're burning cash on a risky expansion. Plus, all those red flags we discussed. Paying a dividend while losing money, the PR versus reality disconnect, and crucially, zero insider buying.
And the tariffs are seen as a permanent problem in the bear case.
Yes. The U.S. tariffs aren't seen as temporary. They fundamentally, maybe permanently, impair Jinko's ability to earn decent profits in a critical market. It's a structural hit to their earnings power.
So wrapping it all up, what's the final takeaway for our listeners? As of June 13th, 2025, $19.48 share price. What does our deep dive suggest?
Well, that $19.48 price is below the low end of our educational DCF range of $22 to $30. So just looking at that, you might think undervalued.
Odd.
But as we've seen, the picture is way more complex and frankly hazardous. This isn't, the classic wonderful business at a fair price. It's more like a deeply troubled business in what might be a cheap price, but with a really significant chance of being a value trap.
So the whole investment thesis relies on...
It hinges entirely on a speculative long-term recovery in the solar industry and on management successfully pulling off this incredibly expensive and risky strategic pivot with global manufacturing 2.0.
So bottom line.
Bottom line, JinkoSolar represents a high-risk, high-uncertainty proposition. It's really only suitable for investors who have a very high tolerance for risk and are prepared to wait potentially many years for a turnaround that might not even happen.
A really fascinating cautionary tale, perhaps. This deep dive really throws into relief the challenges for global companies in this era, doesn't it? How do companies like Jinko balance wanting to be global players with this rising tide of protectionism and fragmented trade policies? And what does that signal for investing in renewables worldwide? Definitely something to think about. We really hope this deep dive gave you a clearer, more nuanced view of JinkoSolar. If it did, please remember to like and subscribe to the Stock Analytics AI YouTube channel. It helps others find us. And members, don't forget you can suggest stocks for future deep dives in the comments.
And just the standard but important reminder, this analysis was generated by an AI system. It's for educational purposes only. It should absolutely not be taken as financial advice. Please always do your own thorough research or talk to a qualified financial advisor before making any investment decisions.
Great point. Thanks for diving deep with us today. We'll be back soon with another complex topic to break down for you.